Okay, so learning objective 3, apply the accounting equation to business organizations. Now, in the classroom, I will kid with the students and explain to them that the accounting equation is one of the most complex equations that you could ever find in the world. And then I'll present it, and here it is. Assets equal liabilities plus equity. And I know that a lot of students look at accounting and think of it as being very difficult. The accounting courses often are thought of as being more complicated, more difficult. And what I'm going to suggest to you that it's really not more complicated. It's not that much more difficult. Here's the accounting equation. Assets equal liabilities plus equity. How much more simple can you get? I will tell you, though, what makes accounting appear to be difficult is how comprehensive it is. There's so much associated with accounting that you wouldn't have even ever imagined. But there's so much to it that now everything becomes confusing because it's not just left, it's not just right, it's not just straight, there's all kinds of variations associated with it. And so for that reason, accounting has often earned a bad reputation amongst students as being a difficult course to take. But I kid with you, I will kid with you, and I kid with students as well. It's not that hard. It's that we don't do anything more difficult than adding, subtracting, multiplying, and dividing. And percentages, it's associated with basic business math. And if you can get past the basic business math, then accounting is not that much more complicated. There's a lot to it, but you can get through it. Here's another way of looking at the accounting equation. We'll see it as all of the assets of an organization. In this case, we're showing that $1,000 of assets. If we were to add up, let's say that $1,000 is made up of cash. We have to really define assets. An asset is, let's do that. What is an asset? An asset is a resource, a company resource that has future value. In other words, it's something that you can sell, something that you can purchase, use, and then even after using it, you may still have value that you can turn around and sell it. So the obvious example would be a vehicle. Most of you buy vehicles. When you buy that vehicle, that is an asset. Why? Because it has future value. Now be careful with the future value concept, because for businesses, future value really means that it will help a company generate future revenues. So the definition of an asset is a resource, a company resource that has future value, and then future value is defined by the ability to generate future revenues. Liabilities, on the other hand, are what we call future obligations, something that we owe, something that you need to pay at some point in time, or that you need to do at some point in time. Be careful. Liabilities is often used by business people even to refer to risk, like, oh, somebody might hurt themselves right here. That's a liability. That's a liability. And even though risk management uses that term, for accounting purposes, that is not a liability. A liability is when you owe money you owe money or a service to another entity or another individual or to someone else, something that you owe, debt, okay? Equity now can be defined as the ownership claim against the asset. So how do we see that a little more clearly? Well, if you have assets of $100,000 or $1,000, if you have assets of $1,000, and those assets may include cash, they may include equipment. It's only $1,000, so it can't include too much. But if you have $1,000, and if you owe $600 against those assets, let's say you borrow money from a credit card and you owe some money to your mom or your dad or whatever, So you use $600 that were given to you by your credit card or by your parents, and you use that money to purchase those assets. Well, you bought an asset. That means you must have had about $400 that you put in yourself. So the equity is the ownership claim. If you had to liquidate these assets, $1,000, well, first you have to pay off your liability. In this case, that's $600. And the difference between your assets and liabilities are going to be the ownership claim, or the $400. This slide talks about the assets, definition, resources expected to produce future benefit, liabilities, outsider claims, debts payable to outsiders, and the stockholders' equity is the insider claim, stockholders' interest in the assets. Example of assets include cash and cash equivalents, inventories, property, plant, and equipment, vehicles, accounts receivable. Those are all assets. Liabilities, well, you owe accounts payable. That's typically when you buy some of the product that you're selling, you buy it on account. That would create an accounts payable. Income tax payable if you owe the federal or state government money for income. And long-term debt, if you borrowed money that you're paying over a long period of time, then that would be the debt. So personally, you probably have a little bit of cash. You don't sell inventory, so you don't personally have any inventories, but you might have maybe a vehicle. You probably have a computer, cell phones. Now, those aren't extraordinary expensive assets, but certainly the vehicle could cost a pretty good chunk of change. So those are examples of assets that you may have. Liabilities for you personally, you may owe credit cards, or maybe you owe your parents. Some parents actually require their children to pay them back for the money that they're giving them for education or something, other things. Maybe you're paying for insurance on that vehicle and you owe some of that, so that would be a payable if you owe it, if it's for the past. And maybe that car that you bought, you're actually paying over time, and that could be a long-term debt. Stockholders' equity is, again, the way I described it to you, is the difference between your assets minus your liabilities. Take the assets, subtract the liabilities, and that's going to give you the stockholders' equity. Stockholders' equity, the term stockholders' equity is just meaning that we're actually talking about a corporation. The real term is equity. Equity is just the assets, liabilities plus equity. But when we use the term stockholders' equity, we're really talking about a corporation. That's why we throw in that word, stockholders' equity. And then when we're talking about a corporation, the equity will be broken down into two parts. This is paid-in capital and retained earnings. Paid-in capital, this is the money that's put into the business by shareholders. And retained earnings, this is the money that is generated or earned by the corporation that is retained for future business. They don't pay it out in dividends. They hold it for the company. Paid-in capital, the amount of stockholders have invested in the business, which is the way I described it earlier. And retained earnings is defined as the amount of earned income kept for use in the business. That's the way I described it earlier. Breaking down retained earnings in a little bit more detail. Where does retained earnings come from? Well, this is about revenue that's generated during a certain period of time. Sales. So if you're in business, you sell your product or service. When you sell it, you are generating sales. As an example, let's say Walmart sells every day. Well, if we're looking at a day perspective, that probably wouldn't be too easy to do, but you could look at it from a year perspective. Certainly every year they generate financial statements. I don't know when their fiscal year ends, but let's assume that it's December 31st. So we could go back and look at 2019 and look, well, how much was the revenue between January 1st, 2019 and December 31st? How much revenue did they get? Then we're going to look at all the expenses that they incurred during that same period of time. Incurred meaning they either paid it out in cash or they still owe it because now they have an expense. They've incurred it now. They either have paid it or it's due to somebody. Somebody owes it. When you have an employee that works for you, you have the expense. What you're going to learn is that you still might have the expense even though you haven't paid it yet. But that's going to be later on when we talk more about that. But we're talking about expenses for the period. So revenues minus the expense for that same period will give us net income or loss. Now, before that year started, let's say January 1st, 2019, we had a beginning retained earnings of everything that happened before January of 2019. Everything before, this is what we started off with. We had some income for this year. Now, what I showed you earlier, and I demonstrated earlier, I showed you how money can be paid out in dividends to shareholders. Well, we take our beginning balance of our retained earnings. We're going to add or subtract, depending on whether they have income or loss to that period. We're going to take our beginning balance of retained earnings. We're going to add or subtract net income or net loss for that period. And then if the board of directors declares dividends, we're going to subtract the dividends paid for that period. We pay dividends based upon income. If there's no income, there's no dividends. But if we made money, we might pay some of these. This is the reward to the shareholders, right? Thank you for investing us. Here's some money. And then, so we're going to take that net income, we're going to subtract the dividends, and that's going to equal what our retained earnings is for the end of the year. So beginning plus net income or subtracting a loss minus any dividends paid gives us our ending balance of retained earnings. This is breaking down in a little bit more detail all that we just reviewed. Revenues, inflows of resources from delivering goods or services. Expenses are outflows of resources due to the cost of operations. And dividends, distribution of assets to the stockholders.